On April 13, 1989, federal regulators from the Federal Home Loan Bank Board took control of Lincoln Savings and Loan Association of Irvine, California. Among the files transferred into the regulatory record that day was a transaction the examiners had already flagged: a parcel of undeveloped desert land north of Phoenix, known as Hidden Valley. The record shows the land changed hands through a buyer named Ernest Garcia, and that the sale generated an $11 million profit, which Lincoln Savings booked as ordinary income for the quarter. The buyer, the examiners found, had put none of his own money into the deal. The gain existed only on paper. The structural question this episode answers is how a federally insured savings institution manufactured earnings out of transactions in which no real economic value changed hands, and why the accounting treatment made those earnings look legitimate for years. To understand the Lincoln Savings case, you have to understand what a savings and loan was permitted to become in the early 1980s and what accounting rules governed the earnings it reported. A savings and loan association, historically, was a narrow institution. It took in deposits from households, and it lent that money out as long-term, fixed-rate residential mortgages. The business was simple, and it was constrained. Deposits were federally insured, first through the Federal Savings and Loan Insurance Corporation, the FSLIC. Because the government stood behind the deposits, the institutions were tightly regulated in what they could hold as assets. For most of the 20th century, a thrift's balance sheet was overwhelmingly home mortgages. That model broke in the late 1970s and early 1980s. When market interest rates rose sharply, thrifts were trapped. They were collecting interest on 30-year mortgages issued at 6 or 7%, and they were paying depositors far more than that to keep the deposits from leaving. The industry was, in aggregate, insolvent on a mark-to-market basis. The regulatory and legislative response was deregulation. The Garn-Saint-Germain Depository Institutions Act of 1982 and parallel changes at the state level dramatically expanded what a savings and loan was permitted to invest in. A thrift could now hold direct real estate investments, equity positions, corporate securities, and high-yield debt. The narrow mortgage lender was authorized to become something closer to a diversified investment company. But the deposits it funded those investments with remained federally insured. That is the structural asymmetry at the center of the entire savings and loan crisis. The upside of aggressive investment flowed to the institution's owners. The downside, if the investments failed, flowed to the federal insurance fund and ultimately the taxpayer. Now the accounting. A savings and loan reported earnings under generally accepted accounting principles, and it reported regulatory capital under rules set by the Federal Home Loan Bank Board. Both frameworks recognized profit when an asset was sold for more than its book value. If a thrift bought land for $1 million and sold it for $3 million, it booked a $2 million gain, and that gain flowed through income and increased the institution's reported net worth. This is ordinary, correct accounting. Gain on sale recognition is a foundational principle. The critical qualifier is that the sale must be a genuine transaction. The buyer must be independent. The buyer must bear the economic risk of the purchase. Money, or a binding obligation to pay money, must actually change hands. If those conditions are not met, there is no sale, there is no gain, and any earnings reported are fictitious. The relevant accounting literature at the time addressed this directly. Under the standards governing profit recognition on real estate sales, a seller could not recognize the full gain unless the buyer had made an adequate initial and continuing investment in the property. The buyer needed real equity at risk. If the seller financed the entire purchase, or if the buyer had no independent stake, the transaction did not qualify for full accrual profit recognition. The gain had to be deferred, or the transaction treated as a financing arrangement rather than a sale. These rules exist precisely to prevent an institution from manufacturing earnings by selling assets to itself through intermediaries. This is the mechanism at the center of the Lincoln savings case. Lincoln, controlled through its parent American Continental Corporation, engaged in a series of real estate and securities transactions structured to generate reported gains without transferring genuine economic risk. The device that made this possible was what the record describes as linked financing, arrangements in which Lincoln or an affiliated entity effectively provided the funds that the buyer used to purchase Lincoln's own assets. The buyer took title. Lincoln booked the gain. But the money Lincoln received in payment was money Lincoln itself had put into circulation. Structurally, the institution was selling assets to itself and recording the proceeds as profit. American Continental Corporation, the parent, was controlled by Charles Keating. American Continental acquired Lincoln Savings in 1984. What the enforcement record establishes is that Lincoln, under this ownership, moved rapidly out of traditional home lending and into direct real estate development, land speculation, corporate takeover securities, and the high-yield bonds then being underwritten by the investment bank Drexel Burnham Lambert. Lincoln's federally insured deposits funded that transformation, and when those investments needed to show returns, the linked financing structure produced them. Consider the architecture step by step, using the Hidden Valley transaction as the model, because it is the transaction the examiners documented most completely. Step 1. Lincoln, or an entity it controlled, owned a parcel of raw land. Its book value reflected what had been paid for it. To generate reported income, the land needed to be sold at a gain. Step 2. A buyer was identified who would take title to the land at the desired price. In the Hidden Valley matter, the record shows the buyer was Ernest Garcia. The stated purchase price was substantially above the land's book value. On its face, this was an arm's-length sale generating an ordinary profit. Step 3, and this is the pivot. The buyer did not fund the purchase with his own capital. The examiners found that the money used to buy the land traced back to Lincoln itself, routed through affiliated transactions. In the linked financing structure, an affiliate of Lincoln would extend financing or engage in an offsetting transaction that provided the buyer the funds needed to close. The buyer put no equity at risk. His role was to hold title so that a sale could be recorded. Step 4. Lincoln recognized the difference between the book value and the sale price as gain, and booked it as ordinary income. In the Hidden Valley case, that gain was approximately $11 million. That gain flowed through Lincoln's income statement, increased its reported earnings, and increased its regulatory capital, the very cushion that regulators looked at to judge whether the institution was solvent. What this means structurally is that Lincoln created earnings and capital out of a transaction in which no independent party bore the risk of the asset. The land had not been validated by a genuine market. Its price had been set by the parties who benefited from the price being high. and the cash that appeared to confirm the sale was Lincoln's own money, cycled through a nominee and returned to Lincoln as evidence of profit. The Federal Home Loan Bank Board examiners, whose findings entered the record when Lincoln was seized, concluded that transactions of this type did not represent bona fide sales, and that the gains recognized on them were not real. The Hidden Valley transaction was not isolated. It was one instance of a repeated pattern. The examiners documented a series of land deals in the Arizona desert and in other markets where Lincoln held large positions in undeveloped property. In several of them, the record shows the same structural features. Buyers with no independent means to fund the purchase, financing that traced back to Lincoln or its affiliates, and prices set to produce a target gain rather than discovered through an open market. Lincoln also engaged in transactions where parcels were sold and, in substance, later reacquired, or where the risk never truly departed. Each of these produced reported income that regulators would later determine was fictitious. Layered on top of the real estate was the securities operation. American Continental Corporation issued its own debt, subordinated debentures, which were sold to the public, and Lincoln held a large portfolio of high-yield corporate bonds. The parent's fortunes and the thrift's fortunes were interlocked. Lincoln's federally insured deposits provided the funding base. The reported gains from the real estate transactions provided the appearance of profitability. And that appearance of profitability supported the parent's ability to raise money from investors. The structure fed itself. As long as new transactions could be booked at gains, the reported capital stayed above regulatory minimums, and the enterprise could continue to operate and continue to raise funds. The subordinated debenture program is worth pausing on, because it is where the harm to ordinary investors became direct. American Continental sold its bonds, in significant part, through the branch offices of Lincoln Savings. Depositors who came into a Lincoln branch, an institution whose deposits were federally insured, were offered American Continental debentures. The record from the subsequent litigation establishes that many purchasers did not understand that these debentures were not insured deposits, that they were the unsecured obligations of the parent holding company, and that they carried the full risk of that company's failure. When American Continental collapsed, those debentures became nearly worthless. Roughly 23,000 investors, many of them elderly, held approximately $250 million in these securities. The linked financing structure that inflated Lincoln's reported health was the same structure that made those debentures appear to be a sound investment. So the org chart in its essential form is this. At the top, American Continental Corporation, the parent holding company. Below it, Lincoln Savings and Loan, the federally insured thrift, and its subsidiaries and affiliated entities. Around them, a web of buyers and intermediary entities used to take title in real estate transactions. And connecting the pieces, flows of financing that originated with Lincoln moved through affiliates and nominee buyers, and returned to Lincoln recorded as profit. The Federal Deposit Insurance Fund stood behind the whole arrangement. The public investors in American Continental debentures stood at the bottom, holding paper whose value depended on the enterprise being what it reported itself to be. The obvious question is how a structure like this survived for years. It involved gain recognition rules that professionals understood. It involved transactions that, examined closely, revealed buyers with no equity at risk. Why did the verification chain not catch it sooner? Begin with the accountants. Lincoln's financial statements were audited. Under the standards governing profit recognition on real estate sales, the auditors were required to satisfy themselves that the buyers in these transactions had made adequate investments and that the sales were bona fide. The record from the subsequent civil litigation establishes that the accounting treatment of these transactions became a central point of dispute, and that the firms involved in auditing Lincoln during the relevant period faced substantial claims and settlements. The structural problem for an auditor is this: the documentation of a linked financing transaction can be made to appear complete. There is a signed purchase agreement. There is a recorded deed. There is a closing statement showing funds transferred. To detect the fraud, the auditor has to trace the source of the buyer's funds back to the seller, and to establish that the buyer bore no genuine risk. That tracing requires following money across affiliated entities that were controlled by the same interests. When the parties controlling both ends of the transaction also control the flow of information, the paper trail can be constructed to withstand a surface examination. The verification failure here is structural. The substance over form principle demands that the auditor look through the documents to the economic reality, but the economic reality was deliberately obscured by the same parties who prepared the documents. Now, the regulators. This is where the Lincoln case became a landmark, because the regulatory failure was not passive. The Federal Home Loan Bank of San Francisco, the regional examining authority, conducted an examination of Lincoln beginning in 1986 and reached the conclusion that Lincoln was engaged in unsafe and unsound practices, including transactions that did not qualify as genuine sales. The San Francisco examiners recommended action. What the record establishes is that the examination and the recommended enforcement encountered sustained resistance and delay. The supervision of Lincoln was ultimately transferred away from the San Francisco office. Regulatory action that the examiners believed was warranted in 1987 did not culminate in seizure until April 1989. During that interval, Lincoln continued to book transactions, and American Continental continued to sell debentures to the public. Part of the delay is explained by intervention that entered the public record through a separate proceeding. In April 1987, 5 United States senators met with the federal regulators overseeing Lincoln. These senators had received substantial campaign contributions from Charles Keating and associated interests. The meetings concerned the regulatory treatment of Lincoln and the pace of the examination. The Senate Select Committee on Ethics later reviewed the conduct of the senators, who became known as the Keating Five. The committee's findings varied among the five. The structural point for this analysis is not the political question, but the mechanical one. The enforcement chain that was supposed to convert the examiner's findings into supervisory action was interrupted, and the interruption bought time. In a fraud that depends on continuous new transactions to maintain the appearance of solvency, time is the essential resource. Every quarter that passed without seizure was a quarter in which more debentures could be sold and more gains booked. There is a further structural reason detection was slow, and it concerns the accounting itself. Regulatory capital was measured using the same reported figures that the fraudulent gains inflated. A regulator judging whether Lincoln met its capital requirements looked at Lincoln's reported net worth. But that net worth included the fictitious gains. The measurement instrument was contaminated by the thing it was supposed to measure. To see through it, a regulator had to disregard the reported numbers and independently reconstruct the economic substance of the major transactions. That is exactly what the San Francisco examiners did, and it is exactly what generated the conflict, because their reconstruction produced a picture radically different from the audited financial statements. The disagreement was not a matter of estimate, it was a disagreement about whether transactions were real. And resolving that kind of disagreement requires the will to override an institution's own reported figures and its auditor's opinion. That will was slow to materialize. Consider what would have had to be true for earlier detection. An auditor would have had to trace buyer financing to its source and refuse to sign off on gains where the buyer had no equity at risk, even when the documentation appeared complete. A regulator would have had to act on the San Francisco examination promptly, disregarding the reported capital figures in favor of the examiner's reconstruction and resisting the pressure to slow the process. And the accounting framework itself would have had to be applied with strict attention to substance over form. Each of these was possible. Each of them failed in this instance, and the failures compounded. The result was that a structure recognizable on close analysis as a mechanism for manufacturing earnings persisted through multiple reporting periods. The unraveling came through the collision of the regulatory timeline with the financial reality of the enterprise. By late 1988 and into 1989, the pressure on the structure was mounting from several directions. The federal savings and loan insurance system was itself in crisis. The FSLIC was effectively insolvent, and the scale of thrift failures across the country was forcing a legislative response that would eventually become the Financial Institutions Reform, Recovery and Enforcement Act of 1989. In this environment, the regulatory tolerance that had slowed the Lincoln examination was contracting. The examiner's findings could no longer be indefinitely deferred. The financial reality was that a structure dependent on continuous new gain-generating transactions cannot sustain itself once its access to funding is constrained. Lincoln needed to keep booking transactions to keep reported capital above the minimum. American Continental needed to keep selling debentures to keep the parent liquid. As regulatory scrutiny intensified and the flow of new transactions became harder to sustain, the gap between reported condition and actual condition widened. The sequence of formal collapse can be stated precisely. On April 13, 1989, American Continental Corporation filed for bankruptcy protection. The following day, the federal regulators seized Lincoln Savings and placed it under conservatorship. The examiner's findings, including the analysis of transactions like Hidden Valley, entered the public record. The cost of resolving Lincoln to the Federal Insurance Fund and its successor was ultimately estimated in the range of $2 billion to $3 billion, making it one of the most expensive individual thrift failures of the entire crisis. The approximately $250 million in American Continental debentures held by the public became nearly worthless upon the parent's bankruptcy. The enforcement that followed established the mechanism in the formal record. The Securities and Exchange Commission and other authorities pursued actions arising from the transactions and from the sale of the debentures. The civil litigation brought by the debenture holders and the actions brought by regulators resulted in judgments and settlements. Charles Keating was prosecuted at both the state and federal levels. He was convicted, and although the initial convictions were later overturned on appeal on procedural grounds, the matter concluded with a subsequent guilty plea in 1999, in which he acknowledged wire fraud and bankruptcy fraud arising from the transactions. The record of these proceedings established as a legal matter the conduct that the examiners had identified as an accounting matter years earlier, that transactions had been structured to divert funds and to create the appearance of profit where there was none. What the enforcement record establishes about the mechanism is precise. The gains recognized on the linked financing transactions were determined not to represent genuine sales. The buyers in transactions such as Hidden Valley did not bear the economic risk of the purchases. The funds that appeared to validate the sales traced back to the enterprise itself, and the reported earnings and capital that these transactions produced were accordingly fictitious. Once the transactions were re-examined for substance rather than form, the reported profitability of Lincoln dissolved, and what remained was an institution that had been insolvent while reporting itself as sound. The collapse of the mechanism, then, followed directly from the collapse of the illusion of independent transactions. As long as the sales could be presented as arm's length, the gains stood. The moment they were reanalyzed as circular financings between related parties, the gains disappeared, and with them the reported capital that had kept the institution open. There was no separate step required to destroy the fraud. Exposing the structure was identical to destroying it, because the structure was the fraud. The debenture holders' recoveries came in part through the litigation against the various professionals and entities connected to the offerings. The record shows substantial settlements were reached, but the timing established the harm. The debentures had been sold, in large part, during the very period when regulatory action had been delayed. The investors who bought during that window bore losses that earlier enforcement would have prevented, because the debentures would not have been available to buy. What the Lincoln savings case establishes as a structural matter is the vulnerability created when a single interest controls both sides of a transaction and also controls the reporting of that transaction. The linked financing device was not exotic. It was the systematic violation of a basic principle, that a sale is only a sale when an independent party accepts genuine risk. Every element of the accounting framework that should have caught it existed. The rules requiring adequate buyer investment for full profit recognition existed. The substance over form principle existed. The examination authority existed. What failed was the enforcement of these existing standards against parties who controlled the information and who had, for a critical period, influence over the pace of supervision. The case produced concrete change in the structure of thrift regulation. The Financial Institutions Reform, Recovery and Enforcement Act of 1989, enacted in the same period as the seizure, abolished the Federal Home Loan Bank Board, and the FSLIC transferred thrift supervision to the newly created Office of Thrift Supervision and moved deposit insurance under the Federal Deposit Insurance Corporation. It tightened capital requirements and constrained the direct investment powers that deregulation had granted, directly addressing the asymmetry that had allowed insured deposits to fund speculative investment. The case also entered the record of professional accountability for auditors and for the standards governing recognition of gains on real estate transactions between potentially related parties. The Keating Five proceeding established separately a documented instance of the enforcement chain being slowed by intervention, and it altered the norms governing contact between elected officials and regulators engaged in specific supervisory matters. The finding that this case leaves in the record is narrow, and it is durable. Reported earnings are only as real as the independence of the transactions that produce them. When the buyer's money is the seller's money, there is no sale and there is no profit, regardless of what the documents recite or what the audited statements report. The Hidden Valley parcel changed hands, on paper, for a gain of $11 million. In substance, nothing was sold, no independent party paid anything of their own, and the $11 million was an entry, not an economic event. The entire architecture of Lincoln Savings' reported prosperity rested on entries of that kind. When they were examined for substance, they resolved to nothing, and the institution resolved with them.